That is the closing bell on Wall Street, and now it's Market Domination Overtime, giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Al Root, associate editor at Barron's, as well as Yahoo Finance's Jared Blikre, joining us here to break down the moves today. Jared, my friend, let's start with you on that close.
Yes, we are on record watch here, and we got that in the Nasdaq Composite and the S&P 500. Nasdaq, that is number 20, the 20th record closing high for the year. It was up only 14 basis points or 31 points, but that was enough for the win. And the S&P 500 up 1/3%, 20 points, and the Dow was the leader among the majors, up 463 or just over 1%. But what stole the show today and over the last few days and maybe the whole week are the small caps. The S&P 600 was up 2% today, and that brings its weekly total closer to 5%. And so an impressive showing there. I'm going to skip right to the sector action. We did have one sector in the red here. That was consumer staples, largely considered a defensive sector, but some of the cyclical sectors like materials and consumer discretionary, those did well today, as did healthcare. We were talking about that throughout the show. Energy also up more than 1%, so a pretty diversified offering here in terms of what was working. What was not working, a lot of those bigger stocks here. You can see Apple and Amazon, the exceptions, but for the most part, the mega caps in the red there. Meta, Broadcom, Microsoft, all down more than 1%. Netflix, Palantir, and Costco also in that same group. And if we take a look at the Dow, we are going to see a lot more green than red. And especially if you look at the right half of the screen there. We got Walmart down 2.5%. That was in that consumer staples group that was in the red in terms of the sector action. But look at Merck. Merck at the very bottom up about 3%, Honeywell up over 1%, McDonald's up 1%, IBM up 2%, and United Health up 4% after getting just absolutely drubbed this year. It's worth looking at the pharmaceuticals page and the healthcare page. Here we have Eli Lilly in the upper left, and AstraZeneca and Merck, each of those up more than 3%. Those are in dark green. Teva Pharmaceuticals, and it looks like Moderna. Each of those up more than 3% as well. I'm going to bring it back and I'm going to close with some of the leaders here. And we can see, broadly speaking, and these are my sector and industry leaders, and just in general, cannabis has been doing very well recently, as it looks like President Trump is set to deschedule, at least lower the scheduling of cannabis. Home builders did well today. That's XHB there. K-Web is Chinese internet. XBI is biotech. And then GBTC, that's crypto. So pretty diversified in terms of the bullishness that we've seen today. Josh?
All right, thank you, Jared. Al, your thoughts on the latest market moves?
More than one way to skin a cat. You saw some of the sectors, healthcare doing really well. Lilly bouncing from last week's earnings report. It had been a big laggard. So we had a day where NVIDIA was down and we still made a record close. This is not a comment on the future, but this is a bull market, right? So we all worry about concentration. You get a day like this, you get some rotation, the market still goes up.
As a longtime market watcher, do you get a little worried when there seems to be not a lot of worry?
Oh, of course.
Yeah.
Absolutely. But, long-time watcher, bull markets climb a wall of worry. We're worried about tariffs. We're worried about valuation. We're worried about geopolitics. We're worried about White House policy. We got 5 or 6 good worries. We have AI. We have a real wage growth improving. The big, beautiful bill is relatively stimulative from a tax cut perspective for consumers. European defense spending is up. Europe has been terrible for years. Maybe they'll get positive earnings growth in 25, which sounds hilarious over here, but like 4% earnings growth in Europe, that's good. So you have some balances. So, is 100%, there's always worries, and it's just the balance of risk reward. People feel pretty good these days.
It's summer, why not, Al?
Exactly.
Well, let's get more insight here, because the S&P 500 and the Nasdaq, they did close at record highs, boosted by more optimism over September Fed rate cut. But our next guest sees risks ahead for the markets and a correction for the S&P 500. Joining now, we've got Barry Bannister, Stifel Chief Equity Strategist. Barry, always good to see you. So, listen, Barry, I got another day in the green. Green everywhere. And listen, small caps, they joined the party too. They're up 2%. What do you make of this melt up, Barry? How do you explain it? Why has the market proven so resilient here?
Yeah, by the way, it's good to see Al Root and put a face with a name. We've talked before. Yeah, there's a lot going on as far as the economy that I think we haven't really seen the full effects of yet. It looks to us like consumption is going to slow in the second half. Um, some pressure on real wage income. So that's just a product of hours worked, what you make per hour. Um, the other is big tech core businesses where they really make all their profits are very sensitive to a slowdown. And so there could be some negative operating leverage there, sudden and late in second half. Inflation, it's if you measure it by the core PCE, it looks like it's going to be close to 3%, and we're thinking all the way into first half 26. So that's not what the Fed wants to hear. So you might have to take some rate cuts out of the 26 futures. And then stagflation, which is slowing economy with still sticky inflation. It's not as bad as the 70s. I remember the 70s. But it's enough to put the Fed in a bind and, again, take some cuts out of next year, certainly before Powell leaves. There won't be another Fed chair in a meeting until June 15th.
Barry, when I have bulls on the show, you won't be surprised. They see it a bit differently. And I guess, Barry, broadly, they'll say, listen, Josh, Q2 earnings season, they'll say it's broadly solid. They'll say, Atlanta Fed GDP tracker, where are we here, Barry? 2.5. And they say, yes, the Fed's cutting. They add that up, Barry. They say, what's not to like? What's wrong with that narrative?
Well, if you look at the core of GDP, and you're going to get a lot of distortions with what's going on with trade in inventories, net exports, and government. I'm not so sure that the big beautiful bill is that stimulative. If you look at the $300 billion tariff, and you figure that the portion consumers have to absorb over time, not initially, but over time, is just going to rise. It actually offsets some of the tax cut, the incremental cut, which was not that large versus what we had in the prior 2017 Tax Cut and Jobs Act. I think it's $600 billion over 10 years, $60 billion a year. We'll offset that with tariffs, the part that goes to consumers. So, bull market psychology is something I've seen off and on for many, many years. And we're in that kind of psychology now. It usually breaks suddenly. It rarely breaks slowly. And so we're seeing a number of risks in the back half. And I highlighted some of them. There's several more.
Barry, let's put a number on it. So if the SPX, the S&P 500 is at 64, 66, where do we head from here, Barry?
Well, we're thinking it could, on a significant economic slowdown with the Fed pretty much battling with the White House, and I expect the last 9 months or so of Powell's term are going to be increasingly an outright war. Then what I think will happen is we're looking at 5,500 as a mid-teens correction for the S&P 500. Now, you could certainly see 5,750, a fairly mild 10% type correction. But that's where our numbers are coming at. And we look at it a lot of different ways, some complex ways, such as economic profits versus enterprise value to invested capital, which is actually very close to where it was in late 1999 before that bust. So there are a number of risks that a overly bulled up market, particularly the investors, retail especially, that they're not really cognizant of. I mean, if you think about the demographics of the market and all the people coming into it, if it were that easy to go straight line and make money and quit your day job, then people would have done it a long time ago. It's a very difficult market. It's like going down a mountain road with switchbacks and no guardrails. And so I just would caution people not to be overly bulled up if it's cash that you need within the next year.
So given that backdrop, Barry, that you've spelled out there, how do I want to be positioned then in the market, Barry? What are you telling clients?
Well, if you think about the Fed, they're the guardians of what's called the neoliberal order, right? They've always believed, and they've written many, many papers on the fact that they believe that you can only have really good economic growth if you have really low inflation. You have a president that wants to run the economy pretty much red hot. He's willing to have the inflation, but only if the nominal growth, the real plus the inflation of the economy, is super strong. So that's a major battle. And then the interlude, while those two fight it out, red hot versus the low inflation is the only way to grow mentality at the Fed. You go with defensives, value-oriented defensives like beat up healthcare, some of the staples like waste companies, utilities. That would be probably a better place to be as they duke it out here in the late third and then early fourth quarter.
Barry, it's always great to see you, sir, and always great to have you on the show. Thank you.
Thank you.
Cisco's fourth quarter earnings, they are just hitting the wire. Shares, you can see they're lower about 2.5%. Let's get to the numbers. Q4 just EPS, 99 cents versus an expectation of 98 cents. Looks like Q4 revenue, $14.67 billion. The street was at $14.63 billion. Gross margins, Q4 adjusted gross margins, 68.4%. Consensus was at 68.2%. Let's spin ahead here. Look at the forecast. Q1 adjusted EPS, they are calling for between 97 cents to 99 cents. The street was at 97 cents. And it looks like for Q1 revenue, the guidance they're given between $14.65 billion to $14.85 billion. The street was at $14.65 billion. And for the year, let's spin ahead. Cisco sees full year 2026 adjusted EPS between between 4 to 4.06 versus an estimate of 4.03 on the street. We're lower there, at least initially. Al, your take on that print?
So stock's down. No harm, no foul. We'll have to see what they say. I mean, like everything, this is an AI stock. They sell networking equipment. We need lots of computers for AI. So, that's bullish. Earnings were up year over year, beat by a cent. It's not a wild beat, right? Didn't beat by a dime and raise their forecast beyond the street. Didn't beat high end of guidance or anything like that. So kind of no harm, no foul. This is a stock that's up 50, 60% over the past 12 months. So you're going to get a dip tomorrow. Analysts who like it will still like it. Analysts who don't like it won't like it. I call this a push.
A push. On the call, my friend, would you be most interested in what Chuck Robbins has to say? Are you listening about the macro? Is it tariffs? Is it AI narrative? What do you want to hear?
Yeah, it'll be tariffs and AI. Your ability to manage tariffs. Again, China tariffs, Canada's been kicked down the road. Lots of people do things like, we're moving things to Taiwan, we're moving things to Indonesia. What the tariff impact will be and how you're going to manage that and offset it, keep margins and earnings progressing higher. That's a good topic, and then it'll just be what are AI orders looking like. They'll just want to hear bullish commentary. So assuming that you get AI bullishness, and tariffs have sort of, throughout this whole second quarter earnings season, sort of not as bad as feared, past peak tariff fears. Maybe you get a dip tomorrow, but again, I think in the poker terms, this is a push.
A push. There is a new CFO here, and I know at least some analysts had predicted that the CFO might take a more conservative approach to the guy because he is new. We'll see. Listen for the call. Al, my friend, always great to have you on the show. Any final words, parting thoughts for viewers, Al?
Oh, parting thoughts. Well, Barry and my mother are the only two people that like to see my face. And
not true. Not true, Al.
Barry is absolutely right. There are a number of risks, and I would just say, keep your bumpers, right? So if you always should be invested. It's time in the market, not timing the market. So if you're a little worried, you can always take a little into cash, keeping that core holding. You feel better about yourself. But most of the time things go okay. I'm just an optimist.
That's just good life advice, I feel like. Most of the time things go okay. Al, it is always great to see you, especially on setup. Appreciate it. Thank you, my friend. Regetti Computing posting earnings results for the second quarter on Tuesday. Its stock has been on a tear over the past 12 months. It's up more than 1,800% as excitement over quantum computing space continues to build. Here to break down the report, we got Regetti Computing CEO Subodh Kulkarni. Subodh, always great to see you, sir. Let's start right with this earnings print, Subodh. You reported the stock finished up today about 6% in today's trade. Walk us through the print, Subodh.
Thanks for having me on the show. We had an exciting quarter, but more than the financial numbers, quantum computing is all about technology development right now and technology milestones. So the run-up in stock price as well as the movement today, I believe, has more to do with our technology milestone demonstration than the actual sales and bottom line number and comparison with estimates. Essentially, what we announced 3 weeks ago and reinforced that announcement yesterday is that we have deployed our latest system on cloud that has 4 chiplets of 9 qubit each, so total 36 qubits with a what we call fidelity, 2 qubit gate fidelity of 99.5%. That's the biggest quantum computer using chiplets at a very high fidelity right now, state of the art. And that's what you see the reaction right now. I don't believe it has anything to do with the financial numbers. It's a huge technology milestone to get chiplets demonstrated at that fidelity because fundamentally it gives you a viable scaling path towards thousands of qubits, which is really what you want in the long term. So hopefully that's the reason why the stock has done what it has.
I do want to get to the technology, Subodh. Just one more question, though, for investors listening. What does the cash and burn rate look like right now, Subodh, at the business?
Sure. So at the end of last quarter, we had about $572 million cash, no debt. And our burn rate right now at the current sales rate is about $60 million a year. So we have plenty of cash to advance our technology roadmap and get products commercialized and get ourselves to profitability in the long run.
For the uninitiated, Subodh, I'm curious, how would you explain the advantages of quantum computing, Subodh, over traditional computing? What does it unlock? What are the problems it solves for?
So fundamentally, quantum computing does things very differently than classical computing that we are all used to. Quantum computing, we use multiple states at the same time, and that gives us an exponentially higher computing capability compared to classical computing. Also, at the same time, it consumes fractionally lower power compared to classical computing. So we get incredibly powerful computer, like million or billion times more powerful than classical computer, at a fraction of the energy consumption of classical computers. And right now there's a huge issue with power consumption related to GPUs. So quantum computing has this dual advantage of higher computing power at an extremely low energy consumption. There are many kinds of problems that cannot be solved with classical computing, like weather forecasting, drug discovery. Encryption is a big one that's getting a lot of attention. Fundamentally, our entire encryption system right now is based on the fact that classical computers cannot separate out prime factors. With quantum computers, you can do that easily, which means you can easily break any encryption code, but it also means to come up with clever encryption schemes, you need a quantum computer. So this whole area with quantum computing of post-quantum cryptography and what quantum computers can do with encryption, as well as many clusters of problems, is getting a lot of attention. Clearly, there's national security at stake here, given the stakes involved. That's the excitement about quantum computing. There are many studies done. There are many numbers that are floating around from McKinsey, BGC, and other agencies. Typically, you see numbers in the neighborhood of a couple $2 billion market size about 4 to 5 years from now, an inflection point somewhere in the 4 to 5 years from now, which we call quantum advantage. And that's when the sales trajectory takes off to 10x of those numbers in about 5 to 10 years after that. So we're talking of a market that's hundreds of billions of dollars a decade or two from now. But right now, we are clearly in the R&D stage. We clearly need to perfect the technology to get to that big milestone in about 4 years, which we call quantum advantage, which is essentially when you can take a quantum computer and take on almost any application that your classical computer does, but does it in a superior way.
I was talking to an analyst today, Subodh, and I guess he was leading to where you were just going there in terms of milestones ahead, because his point was, he said, listen, I think what investors want to know from Subodh is how quickly he can scale up to 100 qubits and then 1,000, because it's sort of like an LLM trying to, doing the work, one GPU versus a data center. What's your answer to that?
So sure, what we have said is there are 4 things we need to do to get to quantum advantage, which is when quantum computers can really proliferate in data center and start doing practical applications as well as solving some really difficult, challenging problems. And those 4 things are: we need a minimum of 1,000 qubits. We need a minimum of 99.9% 2-qubit gate fidelity. We need a maximum of 50 nanosecond gate speed, and we need real-time error correction. Assuming we do those 4 things, we believe we will be able to demonstrate quantum advantage, and that's where business really takes off. Now, all of those things are challenging by itself. The most important one, we believe, is the fidelity one. That's really the most challenging one. this chiplet demonstration we did yesterday, and that's why it got a lot of excitement going, is a clear way to address the qubit count challenge that we have. The chiplets, which are used in semiconductor industry all the time, we see a relatively easy path. I don't want to say easy, nothing is easy in quantum computing, but a relatively easy path to scale up the qubit count to 1,000 qubits from where we are right now. Fidelity, we are at 99.5% today. We need to get to 99.9%. That is probably the most daunting challenge we have ahead of ourselves. Getting the gate speeds, we are already at 60 to 70 nanoseconds, faster than 50 nanoseconds. That should not be a big challenge, particularly for the modality we use, which is called superconducting gate-based modality, where gate speeds are intrinsically very fast. Some other modalities like trapped ion and pure atoms, they have a big challenge where they are more than 1,000 times slower than superconducting gate-based modality. But for us, with superconducting gate modality, that's not a challenge. And real-time error correction is what we use in our classical computers right now. There are many different ways of doing error correction, but we obviously need that to address the last few errors that are left in the system. So we will obviously push to get these four things under control ASAP. Our realistic timeline says we are at least 3 to 5 years away from that milestone right now. So that's why we are using a number 4. Obviously, if everything works in our favor, we may be talking 3, but we are talking technology development. Things may not work exactly as planned, and it may be 5 years. So that's why we are using a median number of 4 to get to quantum advantage.
Subodh, always good to see you, sir. Thank you for your time.
Thank you, Josh.
Time now for to watch Thursday, August 14th. We're going to start off on the economy. We're getting some fresh inflation data on Thursday with PPI. That's the Producer Price Index. Economists forecasting total and core PPI to increase to 0.2% on a month-over-month basis, suggesting that prices producers receive for goods and services rose, potentially signaling some increased inflationary pressure building at the wholesale level. And taking a look at earnings, some more reports coming in on Thursday, including John Deere, Tapestry, and Applied Materials. Applied Materials announced results for the third quarter after markets closed. Analysts expecting the company's sales to get a boost in Q3, driven by strong demand for its chip-making equipment and stabilizing sales in China. And moving over to the labor force, we're going to be getting some fresh data with initial jobless claims. Economists anticipating claims to decrease to 225,000 compared to the previous week, meaning fewer people filed for unemployment benefits and signaling a slight tightening in the labor market. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned.